Okay, so you want to own a self-storage facility. It's the cleanest pitch in American real estate. No plumbing, no kitchens, nobody lives there, so nobody calls you at 2 in the morning about a broken furnace. One employee can run the whole building, some run with none. There are more than 52,000 of them in the United States, covering 2.1 billion square feet, 3 times the footprint of Manhattan. And the industry that owns them earns the highest operating margin in American real estate. That last part is true. It's the part people get wrong. You've heard the number 90%. It gets repeated everywhere. It isn't real. In February, Public Storage, the largest owner of storage square footage in the country, reported what it actually earned. Its same-store net operating income margin was 78.4%. Across the wider industry, it runs closer to 60 to 65. That's still extraordinary. A grocery chain would trade its entire executive team for it. Public Storage's own annual report brags that its margin runs up to 930 basis points above its peers in real estate. Apartments, offices, shopping centers, all of them lose. So the margin is real. Here's the problem. By the end of this video, you'll understand exactly where that 78% comes from, why almost none of it is available to you, what happens to your rent 4 months after you sign the lease, and why this July a regulator in New York forced one of these companies to write a $1.7 million check over the way it prices a room the size of a garage. And you'll understand the thing that makes a storage operator different from every other landlord in America. A legal power no apartment owner has that lets them take everything you own and sell it without ever standing in front of a judge. Let's start with what it costs to get in. A single-story facility, conventional units, no climate control, runs $55 to $85 per square foot to build. That's a construction estimate from May of this year. Go climate-controlled and multi-story, the format everyone is building now, and you're at $105 to $170 a foot. On a typical building, that's millions before you hang a single door. Then the land, 2.5 to 5 acres, and depending on the market, 12 to 45% of your total cost. And here's what nobody puts in the spreadsheet. A new facility takes about 36 months to lease up. 3 years. You are carrying debt on a mostly empty building through 2 of them. Storage breaks even at 45 to 65% occupancy, far below what an apartment building needs. You just have to survive long enough to get there. And the moment you do, you'll discover what the business actually is, because you are not selling space. The first one of these opened in 1964 in Odessa, Texas. An oil man named Russ Williams and his stepson Bob Munn built it out of cinderblock and corrugated steel to hold oil field equipment. They called it a one-use storage, A1, so it would come first in the phone book. 8 years later, a man named B. Wayne Hughes, born to a sharecropper family in Godabo, Oklahoma, who came to California in the Dust Bowl, put $25,000 alongside $25,000 from a partner named Kenneth Volk and opened a facility in El Cajon. Bright orange doors, so you'd see it from the road. He called it private storage spaces. Customers found the name confusing, so he changed it to public storage. It broke even in about 3 months, at 35% occupancy. Today, that company operates 3,533 facilities and 258 million square feet across 40 states. Hughes died in 2021, a billionaire. And the machine he built runs on something that has nothing to do with storage. Here's the mechanism. Look at what happened between the first quarter of 2016 and the last quarter of 2019. Across the industry, the rate offered to new customers fell 6%. Over the exact same period, the rate charged to customers already inside rose 9.6%. Those 2 lines moved in opposite directions on purpose. It's called an existing customer rate increase. ECRI. You are quoted a low advertised street rate, sometimes $1 for the first month. You move in. 4 to 6 months later, your rent goes up 15 to 30%. Then it happens again, and you don't leave. That's the whole business. Not the concrete, not the doors, not the roll-up gate. The product is the fact that leaving is harder than staying. To beat a $20 increase, you'd need a truck, a Saturday, 2 people willing to help, and somewhere else to put it all. So you absorb it. The industry has a rule of thumb for this, and it's stated openly in trade publications. If your rate increase produces less than a 5 to 10% move-out rate, the increase wasn't high enough. They are not guessing. They are calibrating. And listen to how the operators describe it themselves. Joe Margolis, the chief executive of Extra Space, on an earnings call, quote, "The stickier customers are not the moving customers." And in April, on Public Storage's first quarter call, incoming chief executive Tom Boyle was asked directly whether raising prices was pushing customers out the door. His answer, quote, "I would add price elasticity to that list. We have not seen a shift there." Translated, we raised the rent and nobody left. There's a name for why this works, and it isn't marketing. In 1985, 2 researchers named Hal Arkes and Catherine Bloomer published a paper called The Psychology of Sunk Cost. What they demonstrated is that people keep investing in something based on what they've already put into it, driven, in their words, by the desire not to appear wasteful. You have paid 14 months of rent on a unit holding a couch, some boxes you haven't opened, and a treadmill. Throwing it out now means admitting the 14 months were wasted, so you pay the 15th. The facility isn't storing your belongings, it's storing your decision not to decide. And there's a second revenue line almost nobody talks about. When you rent a unit, you get offered a tenant protection plan. It looks like an afterthought at the counter. In 2024, Public Storage's tenant reinsurance brought in $226.6 million in premiums and $169.9 million in net operating income. That's roughly a 75% margin on insurance, and by 2025 it was up 82% from 2019. They didn't stumble into that, they built it. Now, the thing under the floor. If you stop paying your landlord has to take you to court. That's true of every apartment in America. Storage is different. Storage operators hold what's called a self-help lien. They can cut your lock, seize everything inside, and sell it. No court order, no judge, no hearing. 90 to 120 days from your first missed payment in most states. In Texas, they can deny you access immediately on default and move toward auction on as little as 15 days' notice. And this is where the myth collapses. You've seen the shows, bidding wars, hidden treasure, a locker full of gold. Here's Public Storage, on its own website, describing what actually happens. Quote, "Lien sale auctions seldom bring in enough money to cover both the rent due and the cost of holding the sale. An auction is almost always a money-losing proposition. The trade association estimates operators sell only 1 to 3% of leased spaces this way in a year, and an attorney for Extra Space has confirmed something stranger, that some tenants deliberately stage their units, arranging the contents to look valuable, to spark a bidding war and collect the excess proceeds. The auctions aren't the business. The auctions are the enforcement mechanism for the business, and the business is the rent increase you didn't fight. Which brings us to this year, because someone finally fought it. In February, New York City's Department of Consumer and Worker Protection sued Extra Space Storage over roughly 60 locations. Bait and switch pricing, junk fees, vermin, wrongful auctions. On July 8th, Extra Space settled for $1.7 million. While maintaining it disagreed with the allegations. The city's commissioner, Samuel Levine, put it this way, quote, "Like many self-storage businesses, Extra Space preyed on that fact. Not only did this company rip customers off with bait and switch pricing and junk fees, they actually auctioned off people's personal belongings after they protested the price increases. On the 25th of next month, New York becomes the first city in America to require a self-storage operator to hold a license. So, should you buy one? Here's the part the guru videos leave out. About 65% of the 52,000 facilities in this country are still owned by small operators, family businesses, 1 or 2 locations, but they control only about 40% of the square footage, because 5 public companies own roughly 38% of it, and they are still buying. In July, shareholders approved Public Storage's $10.5 billion acquisition of National Storage Affiliates. Extra Space swallowed Life Storage in 2023 and migrated 1.2 million customer records onto its own pricing system in 19 days. 19 days. That's how fast a facility stops being a family business and starts being an algorithm. And the small operator can't run the same playbook. Independent management companies warn each other about this explicitly. Copy the big chain's rate increases, and the 1-star reviews will bury you in local search, which is the only place you compete. The margin is real. Access to the margin requires a scale you don't have. Meanwhile, the whole thing is softening. Same-store net operating income across the big operators fell 2.4% in the third quarter of 2025. Move-in rates dropped 10.7%. Because storage demand is chained to a housing market that isn't moving. As the research firm Yardi put it, as the U.S. housing market goes, so does demand for self-storage. People rent units when they move. Nobody's moving. So, you've driven past 40 of these, and you have never once met a person who told you they rent one. Here's the answer. About 11% of American households are renting storage right now, roughly 1 in 9. They're not hiding it from you. They just don't bring it up, because there's nothing to say. It isn't a purchase they're proud of, or angry about, or thinking about at all. It's a small automatic debit that leaves the account every month, attached to a room they haven't opened since spring. That's who's paying for all that concrete, not people who need storage. People who never got around to not needing it. The buildings are cheap. The doors are cheap. The land is just land. That 78% margin, the best in American real estate, isn't built out of any of it. It's built out of the distance between deciding to leave and actually leaving. Every empty parking lot at every facility you have ever driven past is the proof. The customers aren't there. They already paid. If this changed the way you look at the building at the end of your street, subscribe. We take apart the economics of one everyday business every week.